Well, welcome everyone, and thank you for joining us today for this Pitcher Partners webinar. My name is Craig Watman, and I am a partner in the tax advisory group here at Pitcher Partners in Melbourne. I'm joined today by two of my colleagues. Firstly, Irina Tan, who is also a partner in the tax advisory group, and Elena Bogomilova, who is a client director in the tax advisory group. As we gather for this virtual event and are physically dispersed, I would like to recognise the owners of the traditional lands on which we interact today and pay my respects to their elders past, present and emerging. So we'll jump right into it. This is a webinar about the 23-24 Victorian state budget and the tax measures coming out of the budget. So this is what we will be covering today. Firstly, I'll talk about the COVID debt levy and in particular the land tax component of that COVID debt levy. We'll look at some other tax changes. I'll also talk through the transfer duty reform that was announced in the budget. Then I'll hand over to Irina, who'll take you through the new CSIV rules and other legislative updates coming out of the budget. And then Irina will hand over to Elena, who will take you through the payroll tax changes and the work cover changes that were announced in the budget. So first of all, there was a COVID debt levy announced in the budget. There were two components to that, one being land tax and one being payroll tax. I'll take you through the land tax part, and Elena will speak to the payroll tax part a bit later on in this presentation. So in terms of the land tax section, we have a reduction in the tax-free threshold for general or non-trust taxpayers from $300,000 down to $50,000, which will commence from the 2024 land tax year. So what that will mean is for land holdings with a taxable value between $50,000 and $100,000, we'll have a new temporary fixed charge of $500. And then for land holdings between $100,000 and $300,000, the fixed charge will be $975. And for land holdings with a value above $300,000 for general taxpayers or $250,000 for trust taxpayers, you'll end up with a fixed charge of $975. Plus the progressive land tax rates, which have been increased by 0.1%. So that is the main change that has been introduced in addition to the fixed charges, is that all of the land tax rates have been increased by 0.1% with effect from the 2024 land tax year. So the next few slides just contain the rates and some of the amounts that you will be paying from the 24 year. I won't go through them in detail, but they are there for you to refer to. And when you get the slides, you can use them as a reference point if you wish. But you can see here for general or non-trust taxpayers that we've now got these fixed charges up to a value of $300,000. And then above $300,000 in taxable value, all of the rates have increased by 0.1%. And for trust taxpayers, changes up to the $250,000 rate. And then again, above $250,000, we have a 0.1% increase in the rate that is applicable. So just in terms of dollar amounts, if you take, for example, a general taxpayer that holds land with a taxable value of $1 million, they will be paying an additional amount of $1,675 of land tax from the 2024 year onwards. For a $5 million taxable value, that's an increase of $5,675 of land tax from next year onwards. And similar amounts for the trust taxpayers. As I said, these slides will all be available to you within 3 business days, so you can use them as a guide moving forward. So what does it mean? So for all taxpayers that are currently paying land tax on their land holdings, they should obviously expect to be paying additional land tax, and will be paying additional land tax from the 2024 land tax year. And then for non-trust taxpayers, particularly those that own investment properties and holiday homes with taxable values that are below the current $300,000 tax-free threshold, they may actually become subject to land tax. So they may not have been or currently within the land tax regime on those properties, but due to the decrease in that threshold from 300,000 down to 50,000, their investment properties or holiday homes may now become subject to land tax moving forward. We've also had a bit of a look at the apartment market. So you may be familiar with the way apartments work from a land tax point of view. So generally the land value is obviously shared across the number of apartments, and depending on how many apartments are in the development may depend on whether you're below or above a $50,000 threshold, but certainly given that threshold now is being reduced from 300,000 to 50,000 for those apartments that are held in non-trust holdings, so in individuals or companies, for example, they may find from 2024 onwards that their apartment could start becoming subject to land tax on an annual basis. So these changes in rates and reduction in the tax-free threshold are meant to be temporary. So the government has announced that it is temporary for a reasonably long period of 10 years, but I guess the obvious question is whether that will be the case, whether they will be, the changes will be reversed after the 10 years has expired. Only time will tell the answer to that question. In other land tax changes that were announced in the budget, we have the absentee owner surcharge. So the surcharge that's payable effectively by foreign owners of property in Victoria has been doubled from 2% to 4%. So that rate is now in line with the rate that's charged in New South Wales. And we also have the tax-free threshold for non-trust absentee owners being reduced from $300,000 to $50,000. And that is a permanent measure. That's not part of the temporary COVID debt levy, but it will be permanently reduced to $50,000. On the good side of the coin, from an exemption point of view, there has been an expansion of the exemption that's available in respect of principal places of residence that are under construction or renovation. So currently under the Land Tax Act, it's possible to get an exemption for up to 5 years from what is known as the works start date, where you are constructing or renovating what is your principal place of residence. And due to issues that have obviously occurred in the market recently, there is an amendment that has been introduced which will allow that exemption to apply for up to an additional 2 years where the work is delayed due to a builder insolvency. So just extending that time that you can get the principal place of residence land tax exemption while your residence is under construction or renovation and there is a builder insolvency situation that occurs. There's also 2 new exemptions that are being introduced into the Land Tax Act. The first is for properties that are owned by an immediate family member and used as a home by an individual who is eligible to be a beneficiary of a special disability trust. So that's a new exemption for eligible people who have received a determination in writing from either Services Australia or the Department of Veteran Affairs that they meet the impairment or disability conditions to qualify for a special disability trust. So if there's a home that's owned by an immediate family member of that individual, and that home is used as the residence of the eligible beneficiary, then that will qualify effectively for the principal place of residence exemption. And the other new exemption that's being introduced is for properties that are protected by a conservation covenant with the organisation Trust for Nature. They will also be entitled to a land tax exemption moving forward. And then on to probably the most significant announcement in the budget, but the one that we have the least detail on at the moment because it's not coming into effect until 1 July 24. And that is the government's announcement that the duty on commercial and industrial properties is to be replaced with an annual property tax from 1 July next year. So the annual property tax will be equal to 1% of the land's unimproved value. And what will happen is that the first purchaser of the relevant commercial or industrial property on or after 1 July 2024 can choose to pay what will be the final duty liability in respect of that property, either as a lump sum duty amount or as fixed instalments spread over 10 years, which will be subject to interest. And after that 10-year period is up, then the annual property tax will start applying to the property. So it's not something that's going to come in instantaneously from 1 July next year. There will be a sort of 10-year transition period as those properties are sold, after which time the annual property tax will start to become payable in respect of that property. So this new regime doesn't apply to any current owner of commercial or industrial property where they purchased that property before 1 July 2024. It will only be once that property is next transacted on or after 1 July 2024 that it will come into the new system. So just to give an example of how that might work, we've got a property here with a purchase price of $10 million and its unimproved value is $6 million. And as I said, the annual property tax will be 1% of that unimproved value. So if that property were purchased before or on 30 June 2024, the duty payable would be $630,000. Alternatively, if it's purchased on or after 1 July 2024, that purchaser will have the choice to either pay that $630,000 up front as a lump sum or pay it off over 10 years in fixed instalments, including interest. And here we have assumed interest at the current 10-year Victorian Treasury bond rate, but that hasn't been announced as yet as to how the interest charge will be calculated. So that's just an assumption for present purposes. So that, on our calculations, would give a total amount payable of $744,534, including interest. But then let's assume that that purchaser actually holds on to the property for 15 years. So after 10 years, that property will start becoming subject to the annual property tax at 1% of the improved value, or $60,000 per year. So if they hold it for another 5 years, that owner will pay an additional $300,000 in annual property tax on top of the duty instalments that they've paid together with the interest, giving rise to a total charge of just over $1 million there, you'll see on the slide. So for someone who's holding the property long term, they actually end up paying more than just the duty because they start paying the annual property tax as well. And that's certainly one of the factors that will need to be taken into account by investors of these types of properties. So just in terms of the issues to consider in relation to this, obviously there's a fair bit of detail to come. We expect a consultation period and then legislation towards the end of this year or early next year. But the benefits of the proposed reform are clearly the reduced upfront purchase cost once it's in the annual property tax system, because there'll be no lump sum duty amount, reduced financing requirements because there'll be no duty to finance, and it will obviously allow properties to be more readily transferable between related entities, so it will help internal restructures, etc. In terms of potential drawbacks, then one could say it's another land tax. So this is not replacing land tax. It will be in addition to the annual land tax that would be payable on these properties if they're subject to land tax. And it could therefore result in increased holding costs, particularly for long-term investors. And it has the potential to create a two-tier market, particularly in that 10-year period where you've got some properties that will be available to be purchased for under the duty regimes, the current duty regime, and others that will be subject to the annual property tax. So you may have a two-tier market being created between different properties. So the regime is going to be good for some people and not good for others. And really it's a case of determining whether it will assist you and based on your profile. In terms of uncertain issues, then there's quite a few. Obviously, a key one will be what's the definition of industrial or commercial property? How will that be defined in the legislation? What happens, for example, if you've got a development site, which is existing industrial or commercial property, but then it's turned into residential property after the purchase? Does that come within the regime? How will it interact with landholder duty, which is a separate duty regime, but obviously links into commercial and industrial property amongst other properties? And then importantly, Will landlords be able to pass on the annual property tax to their tenants? Will become quite an important issue for those owners that are landlords. So there's as I said, a fair bit of water to go under the bridge in respect to this regime. So stay tuned over coming months for further details on that. And that is it from me. I'm going to hand over to Irina. Thanks, Irina.
Thanks very much, Craig. Now we turn to amendments introduced by the State Taxation Acts Amendment Bill 2023, which was made public on the 30th of May, just a week after the budget was handed down. So the bill, which is currently with the Legislative Council, contains many amendments comprising the announced budget measures that Craig has covered and that Eleanor will cover a little bit later on. But the bill also contains other amendments that were not referred to in the budget announcements. So one of them is in relation to corporate collective investment vehicles. So the corporate collective investment vehicles, or CCIVs as they're referred to in abbreviated form, they're basically a new type of a corporate entity that's designed for funds management purposes. And the framework commenced on the 1st of July 2022 with the Corporations Act now dealing with CCIVs as the newest type of company limited by shares in Australia. So just by way of background, they were introduced to increase the competitiveness of Australia's managed funds industry internationally to attract offshore investment. So prior to the introduction of CCIVs, the main structure that has been used for funds management purposes or collective investments in Australia is a unit trust structure formed as a managed investment scheme, or MIS. And it's understood that many offshore investors perceive the MIS structure to be inappropriate for large-scale funds management. So this then reduces the ability of Australia to compete effectively with financial centres in other countries that offer significant cross-border funds through the use of corporate vehicles for collective investments. The federal legislation that introduces the CCIV regime doesn't actually set out the treatment of CCIVs and CCIV sub-funds with respect to state-based taxes, such as transfer duty, land tax, landholder duty, and the foreign investor related surcharges. And that is a big issue for the property industry because of the significant impact that state taxes settings can have on property investments, including the rates of taxation, the level of thresholds that can apply, and exemptions that an entity may be able to access. So Victoria is the first state at the moment to introduce specific provisions that addresses CCIVs. And whilst the webinar today is not intended to cover all aspects relating to CCIVs, the complexity and novelty of which should not be underestimated. Before we discuss these specific provisions, let's have a look at what a basic CCIV structure looks like to appreciate why these specific provisions in relation to duty and land tax treatment of CCIVs are important. So this is, as I said, a very basic structure. You can actually have more complicated structures involving CCIVs, but this is a fundamental basic structure which at item number 1, you'll see that that's the actual CCIV itself, which is a company limited by shares. Above it, at number 2 is its corporate director, which according to the CCIV rules in the Corporations Act 2001, must be a public company with an appropriate AFSL authorization. So the corporate director is to operate the business of the CCIV and conduct the affairs of the CCIV according to the Constitution and the Corporations Act. So number 3, so going down in that orange part of this diagram here, that shows the sub-funds. So each CCIV must have at least one sub-fund and it must be registered. And upon registration, it's essentially provided with an Australian registered fund number. A sub-fund, importantly, does not have legal personality, and it must be operated as a separate business from the business of other sub-funds of the CSIF. Item 4 shows the shares issued by the CSIF. So there are different classes of shares that are referable to the different sub-funds. So A-class shares, for example, relate to sub-fund number 1, whereas B-class shares relate to sub-fund number 2 in this example here. Item 5, so down below, you'll see the properties that are held by the CSIF and allocated to the different sub-funds. So in this example here, property 1 held by the CSIF is allocated to sub-fund number 1, and property number 2 is held by the CSIF and allocated to sub-fund number 2. A sub-fund doesn't have legal personality, as I said before, so it doesn't actually hold the assets or incur liabilities. And it just has properties allocated to it, which is done through an allocation register, which the corporate director of the CSIF must maintain with respect to all assets and liabilities of the sub-funds. So at number 6 there, that shows the constitution of the CSIF, which essentially is a contract between the corporate director and each member of the CSIF, and it provides the rules governing the operation of the CSIF. Lastly, at number 7, you have the investment manager, to which the corporate director of the CSIF can delegate powers to manage the operations or investments of the sub-funds. This next slide here basically just summarizes what we just went through. So let's skip that one now and go to this one here, which raises all sorts of issues in the duty space in terms of how does this CSIF regime fit within the existing duty rules in the Duties Act 2000, which as its name tells us, has been around for 2 decades. How does it deal with this CSIF item, if you like, that has only been introduced with effect from the 1st of July 2022? So for example, it raises questions such as CSIF structures to be treated as companies, so unit trusts, which is important from a landholder duty perspective in Victoria, because a private company attracts a 50% significant interest threshold before a landholder duty liability is triggered, whereas a private unit trust scheme only has a 20% significant interest threshold to trigger landholder duty. So that can make a big difference depending on the facts that you've got. And another question might be, while sub-funds do not have legal personality, are they to be recognized at least insofar as the assets allocated to them for duty purposes or for landholder duty purposes? For land tax, various questions are also relevant. So for example, if land tax is assessed at the CSIF level, so that company level with all the sub-funds, I guess, registered underneath it, then technically all the properties held by the CSIF allocated to the different sub-funds could be aggregated or lumped together and assessed for land tax under the one assessment. So is that the case in Victoria, or are they treated as something else? So the provisions introduced by in the Victorian bill that's still before Parliament essentially stipulate that each sub-fund of a CSIF is to be treated as a separate unit trust scheme. And the CSIF itself, so that's the company limited by shares that has a legal personality, that's to be treated as a trustee of each sub-fund / unit trust scheme. And the property of the sub-funds is to be treated as the property allocated to the sub-funds are to be treated as the property of the deemed unit trust scheme. Similarly, extending the concept of translating the corporate features into kind of a unit trust scheme scenario, the members of each sub-funds, which are the holders of each share class, they're basically deemed to be beneficiaries or unit holders of the deemed unit trust schemes. And a share in a CSIF that is referable to a sub-fund is then taken to be a unit in the unit trust scheme that is a sub-fund. And by extension, the rights, entitlements, and obligations and other features attached to a member's share in the CSIF, they're imported and attached to the DEEM unit in the DEEM unit trust scheme. So the rules also provide in the duty space that there is a duty exemption for transfers of durable property between a CSIF as trustee of a sub-fund and a custodian of the CSIF, provided it's in respect of the same sub-fund unit trust scheme. So those of you familiar with managed investment schemes will know that this is broadly similar to an exemption available for managed investment schemes under Section 251 of the Duties Act. Now, this diagram here reimagines the very basic CSIF structure we looked at earlier, which has been translated with the concepts stipulated in the specific provisions applied to it. So you'll see that each sub-fund is essentially deemed as a unit trust, denoted by the triangles on the diagram, and the properties 1 and 2 there are deemed as the respective assets or properties of the unit trusts. And for that reason, each unit trust may be regarded as a landholder for landholder duty purposes, and also a trust owner for land tax purposes. So in other words, for land tax purposes, it is the sub-fund that is deemed and assessed for land tax purposes, not the CSIF. And for landholder duty purposes, if the unit trusts are regarded as private unit trust schemes, then a 20% or greater change in interest in a unit trust may attract landholder duty by reference to the assets underneath it or allocated to it. Now, moving on to another item that was not referred to in the budget announcements on the 23rd of May, but it's in the bill, is an amendment relevant to the windfall gains tax. So many of you attending today's session would have heard Craig and I present on the windfall gains tax since 2021. And many of you will be very acutely aware that the windfall gains tax rules will commence in 17 days' time. That is from the 1st of July. So in a nutshell, as a broad refresher, the tax is up to 50% of the uplift in the value of land as a result of a rezoning of that land. And the trigger event there is the rezoning. So it's a little bit different from, stamp duty or land tax in that regard. And the uplift there is calculated based on the difference between CIV1, which is the capital improved value of the land before the rezoning, based on the most recent available general valuation before the rezoning event, and CIV2, which is the capital improved value of the land per a supplementary valuation done by the Valuer General of Victoria, using the same valuation date as CIV1, but assuming that the new zone was in place at the time. So unfortunately, the amendment is not to scrap the windfall gains tax, despite many of us hoping that that would just disappear like a bad dream. It's still very much alive and still on the agenda, but what the bill introduces amendments to 2 pieces of legislation, being the Taxation Administration Act and the Valuation of Land Act, to essentially stipulate that a person who objects to a windfall gains tax assessment has to object to both the CIV1 and CIV2 valuations used in the assessment, regardless of whether the real issue or objection is to only one of those 2 valuations. So essentially, this amendment is to allow the Valuer General to amend both the CIV1 and the CIV2 valuations used in a windfall gains tax assessment. And essentially, we expect that that's to try and stop a taxpayer from just picking on, say, CIV2 and arguing that it's too high, whilst ignoring CIV1, or alternatively picking on just CIV1 and arguing that it's too low while ignoring CIV2. So given that CIV1 and CIV2 valuations are of the land at the same date, just based on one with the old zoning and one with the new zoning in place, it essentially allows the Valuer General to potentially say, okay, I accept that, you know, in the first example, CIV2 was too high, but that might mean that CIV1 was too high as well. So I will revisit that as well. Now, the last slide that I'm talking to is essentially just a bonus slide that provides a snapshot that is a reminder that there is a lot that has happened or will happen in the state taxes sphere in the various states and territories. So we know that it's a challenge to stay on top of the actively changing state taxes landscape in the various states and territories. And thankfully, our team is on top of them. And as I said, the bottom left corner there, that's just the Victorian measures we're covering today. If you've got properties held in other states, just be very aware that there's been a lot of changes announced and put in place in relation to stamp duty, land tax, as well as payroll tax. And on that note, I will now hand over to Eleanor to cover the Victorian payroll tax and other employment tax changes.
Thank you, Irina, and hello, everyone. So I will take you through the state budget announcements related to payroll tax. I will start with some good news announcements for taxpayers. It is proposed to increase payroll tax threshold from the current limit of 700,000 to 900,000, effective from 1st of July 2024. The payroll tax saving from this measure is just under $10,000. A further threshold increase to 1 million is also proposed from 1st of July 2025. On the other hand, from 1st of July 2024, it is proposed to introduce a diminishing threshold entitlement for businesses with taxable wages between 3 million and 5 million. And businesses with taxable wages above 5 million will not be entitled to any threshold amount. This change, so denial of threshold completely, will cause businesses to pay around 44,000 in additional tax. Coming back to the good news announcements for taxpayers, in addition to other proposed changes relating to corporate collective investment vehicles, which Irina has just taken us through, there is also proposed change to amend payroll tax legislation to exempt taxable wages paid or payable to the corporate directors of corporate collective investment vehicles. So practically, this is where the good news for taxpayers end in this budget. Moving on to the next measure, the state budget announced introduction of COVID debt levy. And Craig has mentioned COVID debt levy in relation to land tax before. So this part relates to payroll tax. This levy is proposed to be introduced on a temporary basis, similar to land tax levy. So from 1st of July 2023 to 30th June 2033. The levy is proposed to be implemented as a payroll tax surcharge on Victorian wages paid by businesses. So the businesses with annual group Australia wages above 10 million will pay a surcharge of 0.5% on the value of their Victorian wages above 10 million. And businesses with annual group Australian wages above 100 million will pay a further surcharge of 0.5% on the value of their wages above 100 million. So effectively, the levy on the taxable wages above 100 million will be 1%. The levy will not apply to exempt organizations, which are currently exempt from payroll tax, so charities, hospitals, and so on. For those who are familiar with the mental health levy, which was introduced in previous budgets in Victoria, this COVID debt levy will operate in exactly the same way. So clearly mental health levy was quite an effective measure, and it was working very well from revenue collection perspective. So the government decided to replicate the same formula for another levy. In this table here, I've done some modeling and wanted to show you the dollar impact of both levies on businesses with different levels of taxable wages. For simplicity, in this example, I have assumed that businesses employ in Victoria only, so all taxable wages are in Victoria. So I have calculated the levies on businesses with payrolls of 15 million, 50 million, 120 million, 150 million, and 200 million. And you can see in the table that the total cost of these levies will range from $50,000 for a business with 15 million worth of taxable wages to 2.9 million for businesses with payroll of 200 million. So this is a cost on top of the business's usual payroll tax liability. Now, this table here provides a comparison of payroll tax landscape in Victoria compared to the rest of the country. I have included the new increased threshold for Victoria of 900,000. Please keep in mind that not all other states and territories' budgets have been handed down yet. So this is a high-level summary and doesn't take into account all special rules which exist in many jurisdictions for different levels of taxable wages. This table doesn't include regional rates, which are available in Victoria and Queensland. Looking at this table, you can see that Victoria has the lowest tax-free threshold in the country, but it also has the lowest payroll tax rate of 4.85. Victoria has now introduced a diminishing threshold entitlement where tax-free threshold cuts off for businesses with payrolls over 5 million. Similar provisions already exist in Queensland and Western Australia. So there is no threshold entitlement in Queensland for businesses with payrolls over 10.4 million and in Western Australia with payrolls over 7.5 million. At this stage, Victoria is unique in having the COVID debt levy. In relation to mental health and well-being levy, last year, Queensland has followed the Victoria's lead and introduced a similar levy. But Queensland levy is imposed at lower rates than in Victoria. So what does it practically mean, and how does payroll regime in Victoria compares to other states and territories? This calculation show comparative payroll liability in Victoria, New South Wales, and Queensland for financial year 2024. So in the first line of this table, you can see amounts of taxable wages. When we compare the payroll tax liability in Victoria with payroll tax liabilities in other states, you can clearly see that payroll tax cost will be higher in Victoria. Unsurprisingly, this is mostly the impact of the two levies we're going to have in Victoria. Interestingly, when I did a similar modeling 2 years ago in 2021, before the levies were introduced, Victoria had very competitive landscape for medium and large businesses due to having lower rate of tax, but it doesn't appear to be the case anymore. Another unfavorable measure which was introduced in the state budget was removal of payroll tax exemption for high fee non-government schools from 1st of July 2024. In the initial press release from the Treasurer, it was stated that the schools that will be required to pay payroll tax will be informed, and this will depend on the levels of school fees charged by the school. In the initial announcement, it was said that the definition of high fee was set at about $7,500 per annum and will be indexed each year. However, I have subsequently seen statements that $7,500 threshold might be increased. A final decision and guidance has yet to be announced. The current amending legislation is drafted to provide discretion to the Education Minister and the Treasurer to determine which schools will retain the exemption. And the factors which they're meant to consider are fees and charges imposed by schools, any other financial contributions received, and any other relevant matters. So the schools which will lose the exemption will be subject to the usual payroll tax treatment and will have to pay tax on their taxable wages at the rate of 4.85% in non-regional areas and 1.12% for schools located in regional Victoria. If schools' taxable wages are above $10 million in taxable wages, they will also be subject to mental health and well-being levy and COVID debt levy. From the discussions I had with our clients and various statements made by affected schools, this change was rather unexpected, and the affected schools will have to be faced with a choice of passing on this tax increase onto families or cut their services. So this is yet to be seen, but I would imagine there will be families with which can't afford the increased fees and will have to pull their kids from private schools and go into the public system. And a last matter which I wanted to cover today is relating to work cover. So Victorian government announced that it would be modernizing the work cover scheme. In doing so, it was set to increase, the premium rate will increase. So the average premium rate will increase from 1.27% to 1.8% of rateable remuneration in order to cover the cost of claims. So this increase will take Victoria higher to the comparative rates in Queensland and New South Wales. And effectively, this increase will mean the increase in premiums of about 42%. So this, coupled with other increases in costs announced in the 2023 state budget, will put considerable pressure on businesses operating in Victoria. The other key reforms relevant to modernising the work cover scheme include establishing Return to Work Victoria to provide more support for workers to return to employment, adjusting the eligibility criteria for mental injury claims, and introducing a whole person impairment threshold of 20% for claims that receive weekly benefits for more than 2.5 years. So this brings us to the end of our presentation, and we will now address your questions.
Thank you very much, Eleanor, and thank you, Irina, as well for your presentation. So if you would like to input any last minute questions in the Q&A function, I encourage you to do that right now. We have left time, but we must have done a very good job presenting to you, because at the moment we only have one question in the Q&A function. So we'll answer that, but if you can think of any others that you'd like to give us, please type them in now. So the question that we have is, what is the unimproved value of the property? I think that is a reference to the transfer duty reform measure that I referred to, and the fact that transfer duty on commercial and industrial properties will be replaced by an annual property tax equal to 1% of the unimproved value. So as I said, we haven't seen any legislation on this as yet, so we're only working off the general government announcements that accompanied the budget statements. But Our understanding would be that unimproved value in the context of the annual property tax will work off the site value of the land in the same way that it does for land tax purposes. So land tax is based on the site value of the land, which is driven off the rates notice. And our assumption would be that unimproved value for the purposes of the annual property tax will also be based on the site value of the land that's used for rates purposes. So we have got a few more questions coming through. Thank you everyone for filling the space there for me. So the next question is, do we have any comments on the second home tax? So I assume that is a reference to the vacant residential land tax that we have in Victoria. We haven't covered that here because there were no changes announced in the budget. So that is still a measure that will apply in Victoria. We are seeing it impact some of our property development clients who have unsold stock. Unfortunately, there is only a limited period in the legislation that those developers have to sell those properties before they become subject to the VRLT, as we call it, or the vacant residential land tax in Victoria. So it's certainly impacting them. And it's also impacting other sort of individual home property owners that may have second properties in Victoria. So we certainly look at the holiday home exemption, or what's referred to as the work pad exemption, to see if we can get them out of that tax on a go-forward basis. But there are quite strict requirements in relation to those two exemption categories, and it's something that we expect the SRO to increase in terms of their compliance activity over coming years. Next question is the flat rate of $975, does it apply to each property title or the entity? If an entity owns multiple properties, is this property, will the property only pay the $975 once? So that is in relation to the fixed charge that will apply for land tax purposes from the next land tax year, the 24 land tax year. So the answer will be that the 975 would apply to each taxable property that is subject to land tax assessment. A payroll tax question, Eleanor. So from Adrian, wages paid currently, what would our payroll tax be, and would we be looking at a contribution towards COVID and mental health levies?
So as far as I understand this question, the threshold for wages to be applicable for mental health and COVID levy is for anything over $10 million of taxable wages in Victoria. So only Victorian wages will be subject to the levies, but the assessment is done at a group or Australia-wide level. So effectively, if wages are less than 10 million in Victoria, but as on Australia-wide basis, the wages are more than 10 million, then the business will be caught for the levies, but it's at a reduced rate.
Thank you. And another payroll tax query regarding the phasing out of the payroll tax-free threshold. Is that starting on July this year, and are there any more details on the model that will be used?
So the phasing out of payroll tax-free threshold will start from 1st of July 2024. What will start from 1st of July 2023 is the COVID debt levy. So effectively, that will start in 2 weeks' time.
Thank you. And another payroll tax question. So with the COVID debt levy and on the payroll tax side, will the taxable wages threshold be based on a standalone business or based on a consolidated basis? So a business that has wages outside Victoria, as an example, similar to the mental health levy.
So it will be based, the threshold will be based on total Australian wages on a grouped basis. So if business on a group basis has more than $10 million worth of taxable wages, then business will be caught for the levy, but levy will only be imposed on Victorian portion of the wages.
Okay, fantastic. Thank you very much. So I think that has answered all of the questions that I can see on my screen here. So we have one more, sorry.
Yep.
So if a purchaser elects to pay duty on a purchase over the 10 years, so we're going to the transfer duty reform here for commercial and industrial. So purchaser elects to pay duty on a purchase over 10 years and subsequently sells the property, will the annual duty charge be able to be treated as an adjustable outgoing for settlement purposes on the subsequent sale, or will the liability remain with the first purchaser? Also, is a subsequent purchaser liable to pay the annual duty for the balance of the 10-year period? Both very good questions. On the second question, first, we don't have the detail on that, but we understand that the subsequent purchaser would be liable to satisfy the outstanding debt. So if they've chosen to pay the duty over the 10-year period and then the property is transacted again within that 10-year period, our understanding is that purchaser would have to satisfy the full amount of the stamp duty installments before that property transfers again to the next purchaser. In terms of outgoings, that's really, I guess, a contractual question more than perhaps a legal question in terms of the legislation. And that will need to be worked through by the lawyers in terms of the settlement statement and what can be adjusted on that settlement statement between the vendor and the purchaser. Alrighty, I think that brings us to an end. Thank you very much for those very good questions. That brings us to the end of our presentation today. We thank you very much for joining us. If you have any further questions that you can think of after the session, please feel free to get in touch, and please watch out for the slides and a copy of the webinar, which will be coming into your inbox in coming days. But we appreciate you joining us today, and have a good afternoon, everyone. Thank you.